Hello everyone and welcome back. In today's video, we discuss everything to do with the stock, crypto and commodities markets right now. And boy, oh boy, has it been a wild 24 hours. Stocks have fallen through their previous supports and now look towards the next level. Cryptos are getting damaged and commodities are flying high. So where should you be positioned right now and what should we be looking at? Let's take a look together at the key levels. Stay tuned. This one is going to be good. All right, everyone. Well, welcome back to, of course, our channel and our daily show here for the markets close 23rd of the 2nd, 2022. If you like anything to do with stocks, cryptos or commodities, please remember to subscribe. We cover it on the daily. And if you enjoy the video, smash that like button. There's no secret. It was a bloodbath across most of the markets that were anything to do with growth. And some stocks moved through massive supports. Things like Tesla moved underneath the key 800. We'll be taking a deep dive in that later. And Nvidia also broke below the last kind of big shorting zones. So semiconductors were under attack. Growth was not doing well. But I think we need to take a step back for a second and just realize what is occurring and what the general stats say about markets like this. Now you may say, but this time is different. But every time is always a little bit different. So let's take a look at what happens when the SP 500 and when the Dow Jones enter correction territory. Because yes, the Dow is making a comeback in our charts today because it has a very kind of scary looking chart when you look at it. So I think the biggest time in terms of the similarities are probably something like this 2018 period where we had a correction period. We've obviously seen the bounce already occur after entering correction because that happened, of course, in January. And now it looks likely that something like this could occur where we see a weakness into the Federal Reserve's planned interest rate hike. And obviously, as we find out more information that comes out of Russia. Another thing that's going on here is also what happens in the Dow when it enters correction territory. And you'll notice things aren't so peachy there either in 2018, the most similar time. Around 1, 2, 3 weeks later, it tends to become quite weak. And you'll notice it's a little bit different stat, but 75% of the time, the market is bullish in the next 12 to 15 months. And you can take some strength in, I guess, that when we're taking a look at markets. But let's get back into the here and now just quickly and talk about what actually happened on the session. And it was a pretty fast sell-off. Basically, the market opened up bullish. We saw that kind of rip occurring through the futures market, and the market opened up, had some easy kind of to see sell off signals, and we'll take a look at a stock that had one in the previous session. Maybe you can spot this in the future. And then it quickly filled that gap. It then rolled back up and did the full death knell. So basically this thing sold off into the close, which shows that Wall Street was committed to the sell-off. Which sectors were doing well and which were doing poorly? It wasn't across the board. We obviously had gold on the uptick, 1.85%, GDX doing very well. Many of you have been really speculating on that for a while now. We've been following gold for a few months and it's really doing quite well. XME also very nice here. The metals and mining, energy spiking, and of course consumer staples, healthcare, all of these kind of utility style positions and staples were holding up the best in the market. It was attack really on consumer discretionary, specifically Tesla, and of course we also saw technology get sold off. So let's talk about conflicts and what happens in conflicts. Well, we've got a two-pronged attack here on markets. There's no doubt that this is a very volatile time. There's constantly flip-flopping going on with what's happening with the Ukraine and Russia, and that is causing some concerns in the market. But history would tell us that that usually, to do with the US market anyway, can fix itself. Maybe this is unprecedented times, but if we go with history, it's usually that kind of 10 to 15 days of potential sell-off and then a rally. But we have much more than that. Of course, we've got the Fed potentially raising rates, and we've detailed many times using this chart that the market is often wrong from what the Fed ends up doing. And in many theses that are being sent around, or kind of ideas that are being sent around here for the higher net wealth individuals, the big banks and the investment firms are kind of saying that actually they believe that if the Fed can instigate and continue volatility in the market right now, it may help them get out of what could be a recession due to, of course, having to raise the rates too high to deal with this inflation problem. Now, we believe that the market might be a little bit too hot in terms of the way that it perceives interest rates. They may still go higher, but in the end, probably the market will come down and the Fed will come up and they'll meet in some kind of medium. The market tends to get it wrong, and these stats show that in really clear way. We also know that, of course, the Fed inflation target, since it was set back in 2007, 2008, really hasn't actually occurred. They wanted 2%. They've really failed pitifully to get that there. So is this just really more of a pickup to get us back to the longer term trend? Maybe if we don't go past this line here, we're still in okay territory in the future. Another thing coming out of the conflicts in Europe are also what's going on with some of the materials. Now, of course, we've seen wheat also be a discussion point. Palladium broke out in the last 24 hours, and there's been a lot of traders pointing towards making these trades based on conflict. It's a good reason. Of course, Russia produces 44% of all the palladium supply, and that's used very, very heavily in terms of the car industry and stuff. But we just need to be aware that while this stuff happens, and while there is this volatility play occurring, just like this, if they say diplomatic solution and it's real, all of a sudden those trades can crash. So just be prepared if you have any of those in the markets. But let's get into the broader market here, and we'll discuss some of the top end factors. Then we'll go through, of course, some of our commodities, some of our stocks, indices, and of course bring our thesis together on what really is happening in this market with the key levels that you need to be looking at. But here we have the US 2-year versus 10-year. This is the first thing you should really be looking at for recessions. If this yield curve inverts, it's very bad. In fact, it has predicted mostly all of the last big crashes. It's like the canary in the coal mine, and we do not want this to be in inversion territory. Luckily, it is not currently. Another thing in terms of buying the dip that some people don't use is something like this oscillator here, which is basically the SP 500 stocks above the 50-day moving average. Now, you always hear this idea of being greedy when others are fearful, but when do we want to be greedy? Well, history would kind of say that if we could be greedy when around 10% of stocks are above the 50-day moving average, that would be kind of that point of potential max fear. So we'll continue to watch this. At this stage, it's at that first kind of dip zone that you usually find is really, really good. And then if it gets underneath, of course, this is the area. We'll continue to put that on our charts on the daily. Another thing people are discussing is PCC. This is put call ratios. Now, traditionally, when a market is going to sell off, what you tend to see is actually a lot less puts in the market than you may expect. When you get down to these 0.66 kind of levels, the market might start to actually get fearful. Remember, the big stock market players, they've already added their shorts. They've already been selling to us as retail traders in every one of these rip rallies. The reason dead cat bounces exist, where the market kind of goes down and then instantly lurches back up, is because the market loves to sell extra positions to us. And all the price action that we've been following on this channel, I think very correctly as a community, we've seen this play out, and we've been very good at spotting this so far. So the PCC is in the middle, and I don't think it's really telling us too much about options this week being worrying in terms of there's just too many puts in the market just yet. That may come up. VIX is above 30. Of course, this is highly volatile. We've talked about this 32 level, and we pretty much expect if the market continues to fall off, the VIX to spike up. But be careful around these levels. This is an incredibly large VIX, and it doesn't tend to stay above 30 for long. I mean, 30 into 40, if you go through history, most of the time, this is where it spikes down. And it really struggles to get above there. Only GFC or, of course, the COVID pandemic can get it to those levels. Let's talk about gold. We'll go into the commodities now. Now, gold has been fairly strong. It's hit our 1910 here in terms of some rejections. You've got 3 to 4 wicks here that are all showing buy pressure coming back into the market for gold, which is good. The next level is around that 1960, which is the resistance on this side. And what we tend to do here is we tend to break down the timeframes to try to find whether we have any good catalysts through this level. I think you've got to be careful here with 1910. So what probably is the better trade is to wait for it to break through, maybe scale positions in, and then wait for it to come back down, get the turnaround story, and then move it into the next level. And of course, if you're in it, you're looking towards that participation towards 1960, 1970. That's going to be the key zone, and it makes sense. And again, gold has been quite good. It's been channeling here for a few days, but if it breaks out, the next trade is fairly clear. We also have Palladium. We mentioned that before in terms of how the market is perceiving it. And of course, the sanctions that are going on and everything else is starting to send this one out, and it has broken past the previous resistance. Now we've got strong weekly kind of pressure coming in here, huge volume as well, and it's moved through. But you've got to be careful with these types of trades as well. Again, they're news related. If something changes, then it all turns around. And I think this little trend line here that we've got through the last kind of lows has been very good. And that could be a zone as well, that if you end up choosing to go with something like this and that becomes one of your trades, then it could be a longer term trend that you may follow for a little while here. Any pullback back to this zone, previous resistance around 24.20, that may be met by buyer demand, a 20 moving average on the 2 hour, obviously a good level or a good zone for you to be drawing up, putting your box structure there, and then understanding whether it meets your system's criterias. Let's talk about US oil. It's up, down, and all around. This remains the really speculative kind of trade. I'm still mostly bearish on the concept, not because I don't think oil can go higher. It's just because I think it can consolidate for some time here. And that all comes back to the thesis of the too far away from the mean reversion, the 20 moving average on the weekly. We don't want to be so far away from it from an extension standpoint. And I would like to see oil come back into this 84, 85. And I think this is going to meet up with this. And what a fantastic opportunity that could be in the future. If you're in oil, remember, it's more of a news trade right now. So you've got to be very, very careful. There's no doubt that we need to be careful in these markets. Let's talk about stocks. And sorry, Tesla traders, it was a brutal session for you. It got through $800, and unfortunately, we saw the signs of this leading up. 945, too much for it. 20 moving average was acting as dynamic support, acted as the resistance, will continue to be a big zone moving forward for people looking to, of course, see a rally in this stock. And this particular candle here, the weekly close was a huge deal. Then we moved underneath it and it just shorted straight through 800. It wasn't even, I mean, it basically brutalized the level. I posted a tweet about it in the morning. I was up very early here in Australia because last night for us, obviously the US morning was such a good trading day towards the short. There was just so much aggression there and a lot of people were feeling very bullish, but you can see how it interacted with the 800 zone. This is a big level. So if we do end up getting rip rallies, which we'll talk about later, this could be another interesting zone for people to potentially look to short in this market. And we'll explain that a little bit later. But yes, Tesla, $800, a big thing. Next up on the support, probably around 700. The psychological levels of every 100 and every $50 tend to be quite strong on Tesla. And that's why you want to target these big areas. For the big bearish kind of players here, a lot of people are starting to call 550. And that's because we're through our trend line that got formed over the last couple of years. This trend line has been obliterated. Obviously, once you get through something like that, then you start to talk about, well, can we get these huge pullbacks? 550 is probably one of the worst case scenarios here for Tesla in the traders' eyes and all investors' eyes. Let's move over to Nvidia. Now, this is where trades happen sometimes, and they happen very, very well. Let's talk about the price action leading into it. Obviously, this whole conflict also leads into semiconductors. They're the hottest sector in the market, possibly the most overpriced in many people's books, and they're the most susceptible to these kind of issues. So overall, we have a double rejection on Nvidia. You can see the weekly rejections, a very strong signal in terms of the short. Then we see the follow through in the last session. And now it's leading into that $200 and the previous supports that were formed through the March lows. So you can see here a lot of information that would make sense for Nvidia to get back down to this level. And it really falls in line also with some of the things that we've seen recently. Now let's go into the 15-minute chart because I just want to talk about Nvidia here. And this is where, things really happen if you know what you're looking for. So obviously you may have a negative tendency to this stock based on the weekly, but you also have very strong resistance here. And what you'll notice is that it rallied and then it just sold straight off there in terms of what happened at the open here on the 23rd. So the 23rd was just bam, straight down and very, very aggressive towards that short side. As soon as you see something like this, what is happening? It's effectively grabbing liquidity, taking out people's little stop losses, and then pushing in one direction towards the bull component And then, of course, the rest of the day was bearish. And these are the types of trades that you can look for when you use the multi-time frame analysis techniques that we often teach here on the channel. And if you want to find out more information about that type of stuff as well, jump into our courses. We've got a course, the Ultimate Trading Masterclass, or of course, the private group mentoring that we host once a month. If you're interested in that, in terms of that's an 8-week session, then you can find the links in the description below. But let's talk about the DAX. This is the worrying stuff. This is really where the whole thesis towards the short here kind of makes sense for a little bit longer. The DAX was the reason that I was up, and it's because we saw the rally into this previous support level. We've talked about the DAX, the German market here, and we've talked about this Wyckoff max pain kind of being formed twice. This is distribution, okay? And when you have this type of distribution and it breaches below, you better be paying attention to this market because it's showing everywhere. It's showing through the Dow, through the DAX, through obviously IWM. It's pretty bad. And this type of thing can lead into, these bigger, short, fast kind of sell-offs. And this is what we're seeing here. So the market has hit this level and then it instantly sold off that zone. Makes sense. It's something we flagged in the previous session. And if you're thinking about where is the support now for the DAX, it could be as low around here, somewhere around that 13,800, which is the previous 2020 highs before this whole crisis began. And a lot of them are pointing towards these types of things. Let's think about the industrial sector here in the US. It's very similar. Look at this. Industrials break below. We've talked about it before. The weekly looked absolutely horrible coming into this, which is exactly why we're putting our opinions at the door a little bit here and just trading the price action. That is not strong price action. That is showing that there is bearish sentiment in this market. It's broken through, and towards this 90, you would think the industrial sector goes. Obviously, there's going to be rip rallies throughout this, but as it comes back up and rallies in, you would think there's going to be sellers committed to trying to get this thing down. IWM, it's the same story. We've broken again below here. The first leg down, the second leg down, the third leg down. Pushes this into 170. What is that? The 2020 peaks. This is the kind of thing that's going on in this market. The pickups were the same. There they are. So of course, we're basically in what they call an A, B, C pattern. Something that's also concerning for many people out there in the market. And then it keeps getting a little bit worse and worse and worse when we start moving around. So we'll actually jump over here to the US 30. We'll go to the Dow. And when you take a look at this market, it's very similar. We have here kind of max pain. We've got a break below the correction territory here. So this is below, and this then points towards further weakness. And this is now in the biggest stocks in the market. So it's not just growth stocks that are selling off now. We're starting to see a sell-off through other sectors. So it's becoming a little bit more of a broader based sell-off. Do we need to be concerned? Well, it depends on whether you can handle these types of potential fall-offs. But if you know what you're doing and if you obviously have a plan, then this could be incredible potential because the stats don't really lie there. Generally, markets will recover. If we go down to these levels, which we'll talk about for the QQQ and SP500, the Nasdaq and SP500, these levels could be really great opportunities. So yes, another weakness here on the Dow. Let's move over to the QQQ. Here we go. And you'll notice it's gone straight through. So in the previous session, we had the long leg doji. That is the high, the low, the open, and the close. You can see that that was an indecision at the support. It's breached below that. That's a clear daily break below. And now what we kind of expect is probably some kind of rip rally, maybe even into the 334 at some point. And then at that point, maybe even some further sell off. Now, if this market goes ballistic in terms of it wants to really sell off, we could also even have this constant sell-off for many, many days. And that's not unknown. It's had happened before in 2018. And obviously in bear markets, they're very, very fast. But rip rally sell-offs seem to be the kind of theme here that's been happening for the last couple of weeks. Every rally we get, we tend to see sell-offs. And those sell-offs tend to be trapping retail traders. From the volume profile, you'll notice that kind of around this 312 area is a fairly big deal. And if we go back over to 2018, so if we actually scroll over to the last time, this is a very similar scenario where basically we broke through a key support And then we went on a big short trajectory for basically a week or two, and that was it. And then it rallied around. And this is the type of thing that happens, that max fear, huge volume, everyone freaks out. So is the next level for the QQQ somewhere around here? It tends to make sense. Somewhere around that 310, 300 level is pretty obvious. There are zones in between it, but that becomes a pretty good thesis. A lot of the reason why is really the SP 500. Here we've got the left shoulder. Here we've got the head. Here we've got the right shoulder. We've got the neckline. You break the neckline from the head in terms of there and there. The distance becomes around 3,800. What is that? Exactly 20% from top to bottom, or very, very damn close to it. This is effectively where markets go from being a technical correction to a crash. So of course we all call it a crash, but really the technical term is that it hasn't done so yet. So the S&P 500 is sitting on the lows of 24th of Jan, and it's really looking like it wants to get through there. In fact, the futures are well under this point at the time of recording of this video. If we move over to the SPY, what is this level? It's 420. Now we know that 420 was a huge put kind of position as well. And if you bring up the puts, yes, there is technically a put wall at 420 for the expiry here for the 25th. So the question we have to ask ourselves is, let's say it sells off on Thursday. Will we see some kind of rip rally that gets us back above the 420 to test that by the Friday close, then further weakness in the next week? The current market conditions are showing us mostly weakness. There's not really any strength here in terms of bullish case for now. There will be, but there's no real strong case for bullish cases. So rallies are going to be met, you would think, by selling demand for at least this period until we find something otherwise. And when we're looking at the SPY, when you're looking at any of these markets, I'm not sure that we've had any kind of bullish action just yet. This is a support. It's through it in the futures. Of course, there's going to be rips. There's now problems with, of course, the 430 as well as there is with the 420. And I think that all of these zones, they're going to need to play out a little bit more before you really start to turn and say, okay, yes, I'm feeling very bullish on this market. For now, most signs pointing towards the bearish side. Let's talk about Bitcoin. It's coming down with the rest of the market. Look, we know that it's not really about Bitcoin anymore. It's about the growth stocks. If Nasdaq is falling, then crypto is falling. It's just that simple. They are correlated. Crypto looks brutal still. We've got that big 30,000 coming up. If you get underneath here, I think we're in a crypto winter. And what that means is it's similar to 2018, where you have this weakness, you break through a key support around that 10 months after that kind of initial big boom. And then what ends up happening is it weakens for further. Everyone gets mass FUD. And then it will turn around and probably do better. So the crypto winter, unfortunately, may be here. We're continuing to watch this on the daily basis. If you look at the daily itself, it rejected on the previous session. You can see here at the time of recording, it's moving towards that short support. And if we get through here, next step, you would think 34, but I think even possibility of that 30,000. So be careful in the crypto world. It's not easy. If you want to go bullish, one of the key zones is going to be here. And that's the 20 daily moving average and around that 39.5 to 40,000. This is a very big area for the crypto markets. Thank you so much for watching. If you did enjoy, please follow us, of course, on Twitter at FX Evolution. We do share some stuff like this put wall with everybody over there. And of course, subscribe, smash that like button. And I've got a question for you all. What's the stock you're buying in this corrective dip? If you are buying anything, tell us. I'm interested to know which one is your highest conviction. Bye for now.